So let's begin by talking about the Indian markets. They have been under pressure, and this has happened over the past few sessions. The Nifty, in fact, if you look at its performance, we've seen the longest selling streak in a year's time. It's lost close to 4 percentage points just in the month of October itself. The sectors that have been affected the most, Realty for one, energy stocks as well, and they've been taking it on the chin the most among the sectoral players. But of course, the key party to this bear grip has been constant selling by the FIIs. 39,000 crore rupees. 39,000 crore rupees all wiped out in the month of October. The FIIs have pulled out. So now the question is, can we expect a revival, a rebound in the markets? And if so, what should be your best bets? That's what we're discussing with Santosh Rao, the head of research and partner at Manhattan Venture Partners. He's joining us along with Geoff Dennis, independent emerging markets commentator. Gentlemen, thanks for making the time. Santosh Rao, to you. The benchmark indices in India, now we've seen them end in the red for 6 sessions on the trot. We've been losing more than 5% market cap each time over these sessions that I'm talking about. The sell-off is sharpest from foreign portfolio investors and foreign institutional investors. What do you think is driving this exodus?
Yeah, I think you saw the strong data last week in the US market. So the fundamentals of the economy, the US economy is on a good footing. And I think that's the key reason why things are coming back to US, back to US market in particular. So I think that's the main reason I can think of right off the top, because the fundamentals, again, US has become a good spot to invest in. Other than that, I don't see, I think in the US itself, I think the debate is shifting, because you see today's market here is on the downside. The issue has become not how much the Fed will cut. It's about, will they ever cut at all, because the economy is so good. So I think that's the debate and that's the confusion right now, and that needs to be sorted out. So I think that's what's playing out here. But on a fundamental basis, US economy is growing very well and the GDP is on a good track. So everything, all the metrics are very good. So I think that I can say why, if you just want to compare India and US, that's where the money is flowing back into US.
So the indices on Wall Street looking strong. Geoff, do you agree that that's the primary reason? Because apart from that, over the last week, the Shanghai Composite Index has jumped 21%. The Hang Seng has surged more than 15%. So now the question is, are the Chinese markets looking so attractive, their valuations, are they looking so attractive that it's coming at the cost of Indian equities?
Well, I wrote about this a few days ago. I'm obviously, this is, I think, one of the factors that's held India down over the last few sessions, that China has had such a huge move here. And China, MSCI China is now up about 35% in dollar terms this year, most of which has happened in the last 2 to 3 weeks. But I think in order for people to continue to be negative on India, you've got to continue to believe that the policy changes in the monetary policy space in China and the policy promises, because that's all they are, in the fiscal space, are going to be enough to revive the economy in China, in particular consumer spending. And I'm very, very skeptical about it. So I think the rotation from India into China by FIIs has indeed played a role here, but I'm not sure how much further it goes, because the fundamentals in India, of course, the valuations are high. The fundamentals in India are obviously, in my opinion, are much, much better than they are in China. Can I just add another couple of points? One is that the dollar has risen in the last few days, and as your previous speaker said, partly because of the payroll numbers last week, and that's that always puts certain EMs under pressure, and also because you've had a big surge in the oil price, which also puts India in particular under pressure. So there's a number of factors here, but for me, it's mainly the rotation from India into China, and I'm not sure fundamentally that's going to go much further.
Santosh Rao, just like Geoff is saying, we have heard this from market experts from time to time, and we need to remind our investors about the fundamental story. Would you agree that that reminding needs to be done? Because when you see the sensex fall nearly 1,100 points from an intraday high, and you see that the sell-off is pretty broad-based, in domestic investors, they're bound to sense a little fear. How is investor sentiment going to react to the kind of fall that we are seeing in the markets right now? Because investors have been very active. Retail investors in India, they've been very active in the markets in recent times because of the fundamentals that Geoff is talking about.
Yeah. Yeah. So I think I see this as a correction was due. I think it's probably an healthy correction because the market had run up quite a bit. There's animal spirits in the market. Everyone's making bet, and that's IPO market is a pure reflection of that. It happened here many times as well. So I think this is part and parcel of that because the Indian story has not changed overnight. Nothing has changed overnight. Things are on track. I think India will also start cutting rates, like all the central banks are. The issue is how much and how soon. But fundamentally, all of the economies are on a good footing at this point. So I think the sentiment should be, hey, hold back. Yes, there is a correction. The smart money, I'm sure, anticipated that and is out of the money out there, out of the market before that. So in that sense, the back and forth, the pull and push and pull of the market is as expected, as normal when the market runs up so much. So that's what. And on the China part, I don't know if you asked me that question, but China part, I feel that as a very temporary boost to the economy. They have more fundamental stories. It's a trading call. You can make some money on a trading basis, but on an investment basis, China, I feel, is still a no touch, especially because they have so many big issues: the demographic, real
yes.
estate, and all the other issues going on there.
Yes.
So there are a lot of fundamental issues that need to be resolved there.
Certainly. So, Geoff, are you sanguine? Because you spoke about this piece that you've written about the strong fundamentals of the Indian markets. Are you sanguine about the kind of valuations you're seeing now that we are seeing the Chinese markets that become that much more attractive valuation-wise? Do you think our markets needed this correction because there was this stretch in valuations, considering all the macro headwinds? On that count, how do the Indian equities look?
No, I think you're right, and I think our other speaker is right as well, that we were due a correction. I don't think we should be particularly concerned about that, particularly with a market that's been so strong for so long and where valuations are high, although of course they always are in India. Now, there's another point which I think is worth bearing in mind, and that is that foreign investors have been overweight in India. Foreign investors just were not in China at all. China was very, very underinvested. So when you suddenly got these actions or promises of actions in the case of the fiscal side, obviously there was a lot of buying that could be done as people started to move their weights up towards neutral. That requires the economy to do better for that to follow through in the equity market. And as we both said, I think on the panel, we're very skeptical about that. The key is, can they get consumer spending going? So I think now is not the time to be rotating out of India into China. The fundamentals in India are so much better in terms of economic growth. There is potential for lower interest rates going forward, as your other speaker said. The currency is behaving reasonably well. I don't see oil prices surging that much more, unless, of course, you get a even more escalation of the situation in the Middle East. And high valuation is just something you have to deal with in India. And I don't think it alters the fundamental story for the market and indeed the economy. And this is why I'm fairly optimistic, although please don't ask me when I think the bottom is of this pullback. I think it'll be pretty soon. But longer term, 3, 6,
Yes.
12 months, I think it will be higher.
I'll try not to ask you where you see the bottom in the markets, but considering the way crude oil prices are moving, Mr. Rao, you know, we are looking at this week itself. 3 central banks are going to announce their interest rate decisions. Bank of Korea, the Reserve Bank of New Zealand, also the Reserve Bank of India, like Geoff pointed out. Globally, we've hit a cycle of monetary tightening. So how do you see that impact FIIs and their exposure to Indian markets, seeing the way oil can change the equation for an emerging market like India?
Yeah, oil is a wild card. We just need this global geographic events to really settle down, geopolitical events to really settle down. So that's going to be a wild card, and it affects because that's a big part of our purchases out there for US and for India and other emerging markets. So the non-commodity markets, not commodity-based markets. So I think that's a big part of our expenses, the India's expenses. So I think that needs to be under control. It's going to have a negative impact if it persists. But at this point, we don't know if this oil spike is a reaction, knee-jerk reaction to what Iran is saying, what Israel is saying. But we don't know if it's going to escalate escalate and how big and how deep. So I think we'll have to wait and see. But generally, there's an air of caution when it comes to the oil prices. And these countries, developing countries, are definitely on the watch to see if this thing will affect them. And the reserve banks will take that into account before cutting rates.
Indeed. So the RBI's policy action is definitely going to have an impact on the course of the markets. Geoff, you'd agree with that. Do you think more or less it's going to be in sync with many other economies right now? We also have the impact of our assembly elections. I don't know how much you've been tracking those, but there is some amount of trepidation because of the kind of numbers projected through our exit polls. So both of these are moving pieces. The kind of action that the Reserve Bank of India is going to take on the policy front, and also politically, the outcome of the assembly elections.
I would say the following, and I think this has just been said before, that I think the rise in the price of oil and the rise in the dollar is going to cause a pause potentially in certain central banks' ability to reduce interest rates here. I happen to think it won't impact the Fed, and the Fed is going to cut by 25 basis points in November and then another 25 in December. But emerging market central banks, Bank of Korea, you've mentioned, they may have a different perspective on whether they should be cutting rates this week, for example. Meanwhile, as far as the assembly elections are concerned, and obviously I'm viewing this from afar, my bet is that the markets over time have really liked the BJP and have really liked the policies that they've been pursuing. The surprise about the general election a few months ago, I think, is something that's gone through. And so unless you really come out of these assembly elections where the BJP is seen to be even weaker still, and it really is going to hamstring their policy agenda, I think you have to assume that this will not be a big factor against the market longer term. A much more important factor for the market longer term is going to be when the dollar starts to go down again, when the oil price starts to go down again, and when this sudden burst of optimism about China blows itself out, because it will, because the Chinese economy is under pressure. So that is how I'd look at these things. In what's very difficult, I accept, very short-term microcosm of the markets here being on, but long term, I think still things look pretty good.
Well, there is something that we call Apada Mein Avsar. So when markets are going down, you're looking at opportunities over there as well. Is this a time to look at some of these sectors more favorably within the factors at play? There would be certain pockets that will act as potential catalysts for a market rebound from this point onwards. And we've been speaking to a lot of market guests about this. Just listen into some of the perspectives, and I'll ask you as well what you think are the potential pockets in the markets that require a second look right now when it comes to seeking opportunities. Here are what our market experts have said.
What we're doing now is looking more and more at the property stocks and also the infrastructure stocks. Those are the two that seem to be interesting. I can't give you names, but those are the sectors that we are looking at more closely. Generally speaking, we are not excited about banks, not only in India, but globally, because there's a degree of problems with transparency and knowing what their loan book actually looks like. But some of these banks in India are beginning to look interesting.
Manufacturing continues to remain very promising. Of course, idea is to avoid the fads and excessively valued stocks, but within that basket of I think we're finding very interesting plays within the specialty chemicals play, which has corrected a lot. We're finding interesting plays in auto hanks. We are finding interesting plays in other manufacturing stories. Pharmaceutical looks pretty good. Within consumer space, with the manufacturing background, we have picked up a few stocks looks pretty good. So banking has corrected a lot. In my opinion, has consolidated. Banking is here to stay. Banking, in my opinion, no economy can grow without banking doing well, and our banking is one of the good shape. So when the chips are down, when the stocks are not doing well, that's the time to kind of take exposure on that.
We have skewed our portfolio towards the consumption name, particularly the FMCG, some amount of pharma, some amount of insurance, some amount of hospitality or healthcare, the hotels, hospitals. These are tourism. These are the names which we think is safety is much more. And obviously, given the background what we are in right now, we have been very vocal that I like to see my portfolio to be more liquid.
Well, there is a stance where a suggestion is that perhaps a portfolio should be a little more liquid right now to spot the opportunities as soon as the turnaround happens, and you sit this one out a little bit at least to be cautious. But on the other side, there are sectors like IT and banks which were doing very well, but now we're not seeing them hold up against the kind of fall that we've seen. Santosh Rao, what's your sense of the sectors that could lead a rebound, if at all we are likely to see that soon?
Yeah, I think to the extent you believe that the economies are rebounding, that there is no recession, I think financials start playing a big role in this whole market. There's a lot of money will rotate back into financials very much. Utilities will continue to do well as a defensive in the portfolio, only because there's a long-term secular tailwind for that. You need a lot of electricity for all the chips and all the production that's going on. I think that's going to continue to play on the infrastructure side. And then you have the chip business, like the semiconductor business is still the future. That's where, so you have to be very selective, but there are pockets in the market that are good. And especially in the US, the market is expanding, is broadening. It was very narrowly focused. Now it's broadening to more than those 7 stocks. So I think in that sense, the economy is getting much better in terms of investments, but you have to be selective, invest in very growth-oriented companies. Same thing applies to India. I think you have to continue on the same same logic as to continue where the economy picks up, as the stock market hits the bottom. The emerging stocks out of this is always the technology, the semiconductors, the cyclicals that come out that do very well when the economy starts rebounding. So I think I'll stick to that. Financials, defensive stocks, and then also healthcare and defense stocks, of course, because of the geopolitical events going on in the defense sector, and healthcare because that's always a perennial favorite of everybody.
Geoff, in your understanding of emerging markets and the way they function, especially after a correction takes place, which are the themes that take the lead as far as the rebound goes?
Well, I think the idea that you should be you should look for liquid names that you can add money to quickly is one thing you mentioned yourself, and I think that's a very, very good idea in a market that's come down somewhat in recent days. I'm very much again with our other speaker here, because I would be looking at selectively at banks because I think they're such a big driver of the Indian economy, and they will not be as expensive as some of the other areas. I think what we got to remember about India, that India is primarily an economy driven by domestic demand as opposed to being driven by export. So I think you look at domestic demand stocks, some of the consumer names as well. And one of your other speakers in your little clip there mentioned manufacturing. I would agree with that. And I think if you do, I would certainly look at tech, because tech's had a rough time lately, not too bad, but somewhat of a rough time in the US. And I think tech will come back. And I agree that in the event that you want something defensive, I'd go for healthcare. So I think it's going to be a mixed picture, but I think the important thing here is to ensure there's some dry powder here, as we say, to put into the market quickly when it looks like this selling bout has come to an end.
Yes, Geoff, I didn't ask you where you see the bottom in the markets, and sometimes it's always a good idea to suggest that don't go bottom fishing, don't kind of time the markets either, and you will see the opportunities, and there are always opportunities in the markets, and that's generally sage advice. Geoff Dennis, and of course joining us, Santosh Rao. Thank you very much, gentlemen, for sharing your views and perspectives on the Indian markets and what we are seeing globally right now as well, with all the action expected from the central banks around the world. Meanwhile, we're watching these crude oil prices. We were speaking about them. They continue to extend gains. Remember, both crude benchmarks, whether it's Brent or WTI, both of them have logged their best weekly gains on Friday. And this is since the year 2023. These are the best gains we've seen, up 12, 13 odd percentage points. Crude oil prices have been moving up, and traders continue to fear that Israel could go ahead and strike Iran's crude facilities. It could be of course, as far as the retaliation measures go to Tehran's ballistic missile attack, now we could see an intensification as the signs augur. But Goldman Sachs has predicted that prices could surge by as much as $20 a barrel next year if Iran's oil infrastructure is attacked. And then, of course, OPEC Plus. Those people, the countries, as part of OPEC Plus, should not increase production. So there are several moving pieces when you consider crude oil prices. We have to continue to watch them. So right now I'm looking at WTI as well, which is at $76 to the barrel even as we speak, which means it's gone up 2.25 percentage points even as we speak right now. So we'll continue to monitor. Meanwhile, oil prices remain this cause of concern for the Indian economy, is something that we're hearing from market experts back home as well, and several people within the financial services businesses. And this is despite the strong performance we've seen. In fact, that's what we heard from the Vice Chairman of HDFC, KK Mistry, was speaking to us. And he had a word about the Indian economy and the impact that higher crude oil prices could play. He was speaking at etnow Swadesh's Samriddhi Summit event earlier. Listen in to what he said about this.
I think I would say last 10 years have been very, very good. What can worry me a little bit is oil. If we were to have some very sharp rise in oil prices, oil goes back to $130, $140 for whatever reason, whether it's Middle East issues or whatever, then that would have some temporary impact on our economy because we are such a large importer of oil, and oil has a big impact on GDP, inflation, current account deficits, and all of that.
So that's one view we got, but also India's Petroleum and Natural Gas Minister Hardeep Singh Puri says that India has several options. He says there are ample options to buy oil because we're buying oil from more than 30 nations now. This is what he said.
Our energy consumption has been steadily growing. Today there is more oil available in the world than there is consumption. If some parties hold back on availability, there are new suppliers on the market also. In the short to medium term, I don't see any shortage of oil in the world. The rest, you know, we have now buying from 39 sources. Earlier we were buying from 27. There is enough oil available and we have enough choices to exercise.
If you like this video, then like, share and subscribe to ET Now.